Okay, I'm happy to introduce our next block of speakers. We will begin with a longer talk and then move into one block of lightning talks. But at this moment, let me introduce Jason Foster, who will be giving a talk on scenario analysis of risk parity using RcppParallel.
Thank you. My name is Jason Foster. I'm a risk manager in New York. I work closely with portfolio managers and I help them understand all the risks in their portfolios. I primarily use R for ad hoc projects. And I also use R for an interface to C++ versus using RCPP, and also for interactive web applications using Shiny. I'm also responsible for helping my group learn more about R. And one example is through DataCamp, which I highly recommend others check out. For my presentation today, I'm going to talk about a package I developed for rolling statistics in parallel. And then I'm going to use it to analyze the current environment and finally extend it to some really simple examples of scenario analysis. So about a year ago, I released the roll package right before this conference. It provides parallel statistics functions for rolling functions. Thanks to everyone so far who has downloaded it and given me feedback. It's been very helpful. And it uses a couple of family members of RCPP. The Rcpp Armadillo package, so it uses C++ linear algebra routines, and it also uses RcppParallel, which makes it very fast parallel programming with RCPP. As you can see, the functions, they range from more traditional rolling means and rolling standard deviations to more advanced rolling linear models and eigenvalues, for example. Over the past year, I fixed some bugs, made some enhancements, and I've added a few new functions as well, sums, products, and z-scores, a little more basic stuff. I also created this package because I really wanted to also standardize arguments across functions, introduce weights across all these different functions, minimum number of observations, which is quite crucial in the time series context if you have enough observations, and then also to handle XTS objects. So if you input XTS, XTS comes out. You can install the latest version on CRAN as well. So a couple of quick examples of how to use this. Rolling statistics, they require a couple inputs from the user. One being the number of observations, and the second being your rolling window size. And it can be really helpful to analyze both short-term and long-term behavior. So for example, as a risk manager, I oftentimes compare the volatility of a portfolio using various lookbacks and weighting schemes. This really helps investors understand the current levels of vol and start discussions on what they believe will happen in the future. So speed gains from parallel computing help decrease that trade-off between number of observations and rolling window size. And this chart shows an example of that. It's a sensitivity analysis of the performance. The y-axis is the amount of time it takes to do, let's say, a rolling beta for 2,000 portfolios. The x-axis is the number of observations, and then the shading corresponds to the window size. Here I'm plotting results for two functions, fastlm from RcPP Armadillo and my roll lm function. I chose fastlm because it's also using RcPP Armadillo, so it's a much better comparison than, let's say, base lm. But also it completely blows base lm out of the water as well. Fastlm is very fast. So for example, in this chart on the far right, we have 2,500 observations, around 10 years of daily data, and at the top of each, green and blue, we have a window size of 1,260 observations, which is 5 years of daily data. The red dashed line at the bottom, it marks 1 minute, and it shows that for all the different combinations of window sizes and number of observations, that the parallel version here is much faster and can also be done as a one-liner in R. I will note, though, that I'm using my laptop. It has 8 threads, so it really also depends on how many threads you're using. You can increase or decrease. It's really what you can do. So how can you do the RcPP Armadillo version to recreate this? So first you download SMP index using QuantMod, calculate the returns, and then you would estimate the beta to SMP by rolling the fastlm function. To do that, you create a wrapper with a wrapper function to extract the coefficients from fastlm, and then you use roll apply with, let's say, a window size here of 252 days. As you can see, it's very easy to use, roll apply, and can also adapt to many other functions as well. So for example, I could swap out fastlm and put in another regression model or other type of statistic for rolling analysis. So the equivalent parallel version here, I'm going to repeat the exercise, and I can use my package. And the way that I'm going to do that is, in one line, I'm going to input X again for my returns and Y, input the window size, again, 252 days, and take out the coefficients here. One of the enhancements I made over the last year was you can now input Y as a matrix. So then the output from this function would be a list of coefficients or list of R-squareds if you wanted. So for example, that for loop across Y's is now done internally using RcppP. So for example, if you wanted to do a rolling beta to SMP for many functions, X would be, let's say, the SMP returns, and Y would be many portfolios returns, and then the output would be that list of coefficients. So what makes it so fast? I'm using the RcppParallel toolkit. It was developed by the RcppP core team. Thanks all you guys for the work you've done there. And it makes it quite easy to create thread-safe parallel algorithms using C++ and RcppP. This toolkit that they introduced has thread-safe wrappers, so the arrays underline R's, vectors, and matrices, and it takes care of a lot of the work for dividing up between threads. And it provides really two high-level parallel algorithms here, parallel for and parallel reduce. So for example, parallel for takes a standard for loop, and then it creates a parallel one. To do that, you would implement a worker object, like square rooting each element in a matrix, and then call it by the parallel scheduler via parallel for in this example. They have many more examples and information on the website which you can check out below. So why is speed important? So we can do a couple of things differently. So we can aggregate data sources and explore trends to help answer questions that are oftentimes quite difficult to quantify. So one of the ways we can start moving into the rest of the presentation is to analyze the current market environment. The first I want to think about is how are people positioned? And the easiest way to do that is style analysis, returns-based style analysis. One way is to, let's say, download returns for 150 portfolios spanning two categories, tactile allocation and world allocation. And then I'm going to apply a 15 asset class factor model on a daily rolling window across stocks and bonds. Here I have the list of stocks, US, Europe, Japan, etc., and for bonds, US, non-US, IG, and high yield, for example. I took these asset classes from Sharpe's style analysis. I've added two more, emerging markets and commodities, really for completeness, given how much they've been driving markets as well. This is a pretty basic approach, though, and it could be improved upon by, let's say, using holdings-based data, but that also depends on data availability, or even some combination of the two. If you had lagged holdings data, you could maybe introduce a returns-based model intra-month, let's say. So these daily returns, we can start to think about style and inferences that come with it. So we can try to measure that consensus positioning by either medians or means or some other aggregation technique. So what I've shown here on the right side chart are the median coefficients from those 150 portfolios using that rolling style analysis. The blue areas on the right are stocks, and the green areas are bonds. The portfolio allocations to equities and bonds, they appear somewhat balanced, and that's typically the case in multi-asset portfolios that are 60-40 or 50-50 equities and bonds. And you can see a couple interesting trends in this chart on the right. Starting from the left, positioning has been increasing slightly as many portfolios de-risked after the US downgrade in 2011, which was slightly before this chart started. And since then, it's been increasing up until, let's say, around 2016, and it's moved sideways since then. But before digging deeper, I've also included the time test on the left. The y-axis here is the amount of time it takes to do a rolling beta calculation, and the x-axis is the number of simulations, which I'm going to use later in a scenario analysis. And the plot results, and the time results here shows that the roll LM function is around 25 times faster. So we can use those coefficients and come up with a couple of other interesting statistics from it. So although the previous slide showed that the portfolio allocations to equities and bonds appeared somewhat balanced, risk contribution here is showing us that it's quite dominated and concentrated by equity risk. The chart on the right, it shows the results from taking those median coefficients from the previous slide and calculating two things, the total risk and the risk contribution by each asset. So as many people know, risk contribution again is on the right. It's the blue areas for stocks and the green areas for bonds. And since equities typically have much higher risk than bonds, that balanced portfolio, 60-40 let's say, leads to a portfolio here that has most of its risk budget in equities. This also means that the return variability is mostly going to be explained and driven by equity markets through time. At the top on that chart, I'm showing the total portfolio's risk as well. So starting from the left, recall earlier that chart on the left where we had low levels of positioning. Here we're actually seeing quite elevated levels of portfolio risk from the left. And recall again, after that the positioning was increasing and then moved sideways. But here this portfolio's risk has actually been decreasing and currently it's at the lowest level over this period. Before answering questions about what's going on and what's causing these results, let's check out the speed test on the left. For the risk contribution calculation, I'm using rolling covariance matrices, and it shows that the rolling covariance function in the roll package is around 44 times faster than a weighted covariance function, cov.wt. So why? What's going on in this chart? So let's start to think about what's happening in the markets recently. Some people characterize it as having mixed economic data and rising geopolitical risk. On the economic data front, we have unemployment rate at the lowest level in 10 years and strong job growth, but sluggish wages. And then on the geopolitical risk side, we have North Korea, Russia, and the rise of anti-establishment movements. So what does this lead to? Well, for both realized and implied vol, it's actually at an all-time low. For example, recently, 2 weeks ago, VIX fell below 10 for the first time since 1993. The chart on the right shows a time series of volatilities. Again, the blue lines for stocks and the green lines are for bonds. Not only has realized equity vol is greater than bond vol, which is causing that risk contribution chart we saw earlier to be mostly dominated, but it's also been decreasing the most. Those blue lines have been decreasing more than the green lines. And that's driving that portfolio risk on that previous slide to decrease to its current low level. And then also the chart on the left shows the current speed test results. It's around 93 times faster than the base standard deviation function. So getting back to the markets. So many people are debating about that current level of vol. Is it, let's say, short-term behavior and will rise back to average levels? Or is it going to persist and maybe remain low like we saw in pre-crisis 2004 to 2006, let's say? We can also start to consider these questions in the context of systematic strategies, ETFs, risk parity, managed vol, et cetera. The list goes on. So just taking one of those, risk parity, we're going to keep it very simple and talk about that at a really high level. So at a high level, considering a portfolio of, let's say, in assets, a vector of weights, and a covariance matrix sigma, we can start to calculate the vol of that portfolio, and then we can decompose it by using risk contributions. Risk contribution is a common risk metric. I use it a lot in risk management. It's nice because it's additive and it uses vols and correlations. So typically, for example, correlations between equities and bonds is negative, so we get some diversification benefits and see a negative risk contribution from bonds in a multi-asset portfolio. Not only for asset classes, but you can also decompose risk using factors as well. And then on the optimization front, you're going to solve for weights to get equal risk contribution across your asset classes. To do that, you'd use solve a nonlinear constraint optimization problem and target some level of risk, let's say. You can actually incorporate all of those conditions into one equation using a Lagrange multiplier. However, in practice, it is also possible for managers to have discretion over the timing of investment decisions for a couple of reasons. One, if they wanted to achieve a strategic or tactical asset allocation. And then also risk parity can be constructed using factors instead of asset classes like I am here. So we can start to think about scenario analysis and take the rolling stats that I've been calculating earlier and feed them into a risk parity strategy. Here I'm going to go through some of my assumptions briefly. Using the 15 asset classes from Sharpe's style analysis, my risk settings are long-term with exponential decay. And most risk parity funds, they do take a longer-term view as well. The approach here is very passive, again, using equal risk contributions. Another approach would be active, where risk parity might be the starting point and then investment managers can change based off of views or other things. Here I'm keeping it simple and having a vol target of 10%, rebalancing monthly, very systematic. Alternatively, you could, like traditional portfolios, rebalance maybe the target and asset allocation if you wanted. So now we can think about that and start thinking about the current environment, like I showed earlier, of low realized vol, and start to consider a few simple and generic scenarios. Scenario one, calling that return to average, where vols and correlations go back to average levels. Maybe the current low levels of vol are short term and it's going to go back soon to average. Scenario 2, you're seeing low correlation and low volatility. In this scenario, perhaps you're going to see markets continue to perform well with solid economic data, but without any sort of global themes, maybe we're going to see low correlation. This could possibly be described as a growth divergence scenario. And then in scenario 3, vols and correlations go higher, possibly a volatility return scenario, standard risk off scenario where vols and correlations increase. There's a couple of catalysts that come to mind: delay in US tax reforms, Eurozone disintegration risk, Chinese credit tightening, crash in global bond markets, trade wars, etc. Anyway, but the important part is my assumptions here for risk parity, just one set of many different approaches you could take. I'm keeping it very simple. And also I've introduced and very strongly suggest others to think about correlation in these scenarios as well. So starting with the first example, returning to average, we can simulate those scenarios, the standard deviations and correlations, using a custom parallel function I wrote for geometric Brownian motion with correlation using RcppParallel. And the chart on the right shows some of the results. The leverage that's required to achieve that target risk of 10% using the simple risk parity strategy I just went over. In this simulation, leverage decreased after the Fed tapering scenario in 2013. Vols did increase, but also the correlation between equities and bonds became quite positive at that time, so causing that leverage to come down, and it was much easier to reach a target risk of 10%. And then since then, leverage here appears to have steadily increased as vols have started to decrease, as we showed a few times earlier. From there, on the right side, you can start to shock things different ways. So if you wanted to shock vol higher, back to average levels, which is the blue line, that leverage decreases because it's easier to reach that target risk of 10%. Or you could shock correlation to average levels and keep vols the same, which is that green line. Leverage slightly increases because of diversification, as that correlation becomes slightly more negative. But overall, there's not too much change there. And then the chart on the left shows, and then you could also shock both at the same time, correlations and vols, which is the gray line on the right side. But like I said, there's really not much change there given where correlations are currently and the long-term nature of my assumptions for the risk modeling. And then the chart on the left shows the results from the speed test from the functions I wrote, custom functions I wrote for geometric Brownian motion, around 81 times faster just using RcppParallel. And from there, we can explore the other two scenarios, again using parallel programming, parallel computing, and it's much faster to be able to explore and dig deeper and faster into these different scenarios or others as well. So here I've repeated it for scenario 2 and scenario 3. Scenario 2, I'm shocking correlation lower, which is the chart on the left. Leverage slightly increases because of diversification, that reduces risk. Or you could shock vols much higher as well, which is the chart on the right. Scenario 3, leverage decreases because it's easier to reach that target risk of 10%. And then the total shocks here, you can see a couple things. One, it really depends on the starting levels of vols and correlations, the volatility assumptions, and the correlation assumptions. Here, as you can see, I've picked two different scenarios, two different sets of catalysts, and two very different outcomes. So to recap, I talked about a package I developed for rolling statistics and parallel. Then I used it to analyze the current market environment, and finally extended to some simple scenario analysis using a risk parity strategy. Most of the functions I went over today are available in my roll package, and all of them use RcppParallel, which is very fast. And you can install the latest version from CRAN or development version from GitHub. Thank you.